Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Alix Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we'll look at how drug makers are being impacted by policy in Washington, D.C.
Plus, we'll discuss how one bank is abandoning its net zero financed emission goals.
But first, we begin with the airlines industry. This week, Delta Airlines withdrew its full-year financial guidance due to uncertainty surrounding global trade. And this comes despite the airline reporting better than expected first-quarter profit.
For more on this and the state of the airline industry, we were joined by George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We first asked George to break down what happened during Delta's first-quarter earnings call.
The call wasn't as bad, I think, as a lot feared. A lot of what we heard was the premium markets are still good. Europe is still good, but they're watching it very closely. Asia Pacific was a good market as well. Non-premium, back of the airplane travel in the domestic market is poor. And because of all that, they're going to they're going to flatline capacity, no growth for the second half of the year. So it sounded like things are okay, maybe. They're okay, right. But we're watching things very closely.
But I remember that Delta and the other U.S. carriers probably several weeks ago cut their guidance. This was before, I think, an investor conference. So they've already cut guidance once here.
Agreed.
So where are we there? I mean, do you feel like street estimates need to come down here?
Agreed. Well, so when I looked at the preliminary guidance for 2Q, it did seem like street estimates for 2Q had to come down, right? Because Delta gave some pretty broad ranges, but it looks like capacity is going to rise 5% when I look at schedules for them in the second quarter. And they said revenue could be up 2 to down 2. And if I did my math right, that means that I think either way, fares are softening. Again, we're definitely working off lower expectations after they cut earnings expectations after the JP Morgan conference. But seas are choppy here. Sorry,
George, I know every year you take a boondoggle over to Europe, either to London or Paris for these air shows. And this is where these big airlines place big orders with the airplane suppliers, Boeing and Airbus principally. Are we going to get to a period, George, where if they even allow you to go to Paris, if the French let you in, will European carriers buy Boeing planes and vice versa? Will European carriers buy, Airbus?
I think they will. I think they will because the queues for airplanes are so long. You're not going to get out of the queue you're in and go to someone else's queue and wait longer. You'd have to wait 7-8 years for an A320 out of Airbus. I think, as near as we could tell from the backlog they show. But what I will tell you about discussions with Ed Bastian about taking Airbus airplanes and who pays a tariff. And he said he's not going to pay a tariff and he's not going to take any deliveries, very few deliveries this year. So it does sound like Delta has a tariff problem and isn't ready to take new airplanes. Now I know they're flatlining capacity for the back half of the year, so maybe they don't need them. But if the market was growing significantly right now, I think he'd have a problem.
So you mentioned kind of the weakness Delta was calling out in the back of the plane, maybe some of the more economy prices and seats. So does that mean the discount airlines, they're really going to face some trouble?
Yeah, I mean, the funny thing is, again, when sort of Delta, United, and American adjusted earnings a month ago, the low-cost carriers did a little bit, but the moves weren't as great. And the low-cost carriers had already been cutting capacity, right? If you think about it, Spirit Airlines went bankrupt. They cut, 40% out of their schedule or something like that, 30% out of their schedule. Southwest significantly slowed growth. They went close to zero. JetBlue has been cutting. And now Delta came in today and said, look, we're going to cut the back half of the year to flat. So I feel like the full service have to make up ground here because they had been growing a little bit too fast. We had seen that in the beginning of the year. We're going to see an earnings season whether or not maybe low cost got ahead of the curve here. Mm-hmm. I still can't believe that Delta can deliver a seat as cheap as a low cost carrier. So I personally think the low cost carriers still have a valid business here and they'll fill airplanes and do okay. But when you get into times of trouble in this industry, trouble is big in this industry, right? There's a lot of operating leverage. And so we're going to see, right? We're going to...
Hey, jet fuel prices are coming down. I mean,
they are.
That's a thing. 30 seconds.
They are.
Top airline to manage all of this right now. What do you think?
I'd go with balance sheets, right? And that's going to be companies like Southwest and Delta that have strong balance sheets can weather storms.
Our thanks to George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst.
We move next to the consumer goods industry. This week, Constellation Brands issued downbeat guidance for the year as new U.S. tariffs and muted demand weigh on the beer, wine, and spirits maker.
For more, we were joined by Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst.
We first asked Ken for his take on Constellation's most recent guidance.
There's so many moving parts to the Constellation storyline here. It's really a challenge on analysts to put it all together. But you touch on the right points, and that is the near-term challenges facing Constellation and other brewers, for that matter, is weak demand. A lot of it is economic. Constellation would also point to their key demographic is the Hispanic demographic, and they're having a little tougher time with the employment situation and the slowdown. But they have some longer-term threats also. I mean, you have more substitute products. You have legal cannabis. You have the hemp-based CBD THC products that are now gone Main Street. You don't have to go to a dispensary to buy THC anymore. You can just go to the local liquor store. You have the GLP-1 drugs, where people our studies show that are consuming less alcohol because they're on those drugs. All those things are weighing on the near term and perhaps longer term sales growth potential for beer. And that's what the analysts are trying to wrap their heads around right now.
What is the price elasticity on alcohol? Can these companies pass along price increases?
Well, it depends on the product, Paul. The good news among that otherwise onerous outlook is that Constellation's Corona and Modelo brands lead the market in terms of growth. Those products continue to command premium prices. They're growing faster than the market. So they're generating best-in-class operating margins on those products. But, they're not immune to the slowdown. And clearly, they lowered their guidance. While their fiscal fourth quarter came in a little better than expected, some of the concerns out there is they lowered their longer-term sales growth projections. It used to be, a high single-digit kind of sales growing segment for many years. They came out and said, over the next few years, you're going to see more like low single digit. And the analysts were a little taken aback by that. And to Alix's question before, how much is that near-term, cyclical economic issues, and how much is longer-term demographic things weighing on this category?
So,
and no one really knows. Yeah, we'll find out.
Nobody knows, right? So then what does Constellation do about that? Like, do they go build a beer plant in the U.S.? Do they look for some M&A? Do they pare back? Like, what do they do?
Well, they're innovating. I would argue that Constellation is one of the more innovative beer companies. So they're taking that base of a really good brand family of Corona and Modelo, and they have Pacifico, but they also are extending into cheladas, which are very flavorful beer malt-based products. They're getting into the malt-based, seltzer markets a little bit. They used to do it, but I think they're coming back with a better product now. They have a no-alcohol version, Corona. So it's innovation, I think, that they believe can continue to drive sales growth. But there's no silver bullet. I mean, there's no big acquisition out there, I don't believe, that they're going to make to enhance their growth. I think they have a good brand and a good asset to grow. But again, you're not going to escape the long-term headwinds facing alcoholic beverage products in general, as a matter of fact.
So can you follow the beverages, the tobacco, and the cannabis companies? Is there a place to hide in your sector here in a world where we're going to see potentially slower growth from some of these trade policies?
Well, of the ones you mentioned, Paul, I mean, the tobacco, particularly cigarette company, those cigarettes are some 90% of that business still. They are pretty much immune to the tariff situation. It's pretty much a domestic business. Yes, there's some tobacco leaf imports that come in and so on, but by and large, that's a domestic business. So if you're worried about tariffs, perhaps that's a place where you can go. In terms of beyond tariff threats, really the soft drink side of beverages is a good place to be. I would argue that even the tried and true carbonated beverage sodas, the diet sodas, are still performing pretty well. They're innovating well. Keurig Dr. Pepper continues to come out with new innovation that's moving that category. They're kind of leading that category's growth right now. They're doing a pretty good job doing it. So that's a good place to go in terms of the universe that I cover. Cannabis is tough. Cannabis, the regulation on cannabis is not easing. The Trump administration is not being kind to the cannabis industry, and we're not expecting much in the way of legalization, liberalization near term, with the exception of some states. Some states will probably continue to legalize, but from a federal point of view, I would wait for the next administration.
Our thanks to Ken Shea, Bloomberg Intelligence Senior Consumer Products Analyst.
Coming up, a conversation with Workday's Chief Technology Officer on artificial intelligence.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Each week, we look at research from Bloomberg NEF, previously known as New Energy Finance. They're the team at Bloomberg that tracks and analyzes the energy transition from commodities to power, transport, industries, buildings, and the agricultural sectors.
We recently looked at the effect of President Donald Trump's policies on clean energy markets. This week, President Trump announced he's raising tariffs on Chinese goods.
Many critical minerals and energy products come from China and are subject to these tariffs, and that could have a big impact on clean energy moving forward.
Separately, a Trump administration executive order said it's exempting 47 coal-fired power plants from stringent air pollution mandates, and the goal is to revitalize the coal industry.
For more on all of this, we are joined by Derrick Flakoll, BNEF lead U.S. policy analyst.
We first asked Derrick what he makes of the executive order on coal.
Well, the executive order is interesting because this is sort of a replay of what Trump tried to do in his first term, right? He had previously talked about increasing payments to or using emergency powers for preserving existing coal plants, maybe bringing old ones back online. And as we can see from the power generation data, that didn't really work out. Coal is now 15% of generation in the U.S. per year, down from considerably higher levels before. So there's a lot of different moving parts to this. You might see more, say, coal exports, more long-term gathering of coal leases, which have been sort of moving back and forth from Obama to Trump 1 to Biden and now to Trump 2. But in general, it's hard to say that this will be a huge boon to coal build out or restoration, especially when you have tariffs weighing on any kind of big capital project.
All right, so talk about, the energy ecosystem. Where do we get stuff for the energy ecosystem, whether it's fossil fuels, clean energy? Where do we get the equipment, and is that something that's going to be impacted by these tariffs?
Oh, very heavily. Even for fossil fuels, which are often a very domestically extracted resource, there's reliance on steel, aluminum, specialized equipment that's imported, which is why you saw the Dallas Fed register such negative opinions about the tariffs coming in generally. More broadly, in terms of, say, solar equipment, that mostly comes from Southeast Asia because we've had tariffs on China for a long time. Batteries themselves tend to come from China. Electric vehicles are imported from a variety of places, but especially, it's very domestic, but a fair amount of Canada and Mexico in there. And lastly, if you're thinking about, say, offshore wind, that's pretty dependent on Europe. The only thing that's really effectively onshore and minimally dependent on trade is onshore wind in the U.S.
What is the future of offshore wind in the U.S.? I mean, if we're talking about ramping up coal and sort of there's zero love from the administration on offshore wind, have we seen sort of, leases or any contracts be broken, or do you feel like companies that are still committed to the longer term world of offshore wind?
Well, I mean, what the offshore wind companies will tell you is this is a multi-year, long-term process of building that's beyond any one administration. We have seen one lease be canceled by the federal government for an ongoing project, but generally speaking, we haven't seen a lot more movement for things that have already been permitted and leased. Now, that's important because the federal government has a lot of leverage over that process. We're not seeing a lot more being added to the pipeline. But the real issue is going to come in the form of costs, inflation, and also potentially interest rates. We saw a major slowdown in offshore wind under Biden, which is a very supportive administration, simply because the cost of inputs went up, and as inflation went up, the Fed hiked rates. And wind is a very large capital-intensive project category and especially sensitive to those kinds of things. So if the tariffs lead to those broader impacts, we might see some fairly negative results for even the offshore wind projects that are already allowed to go forward.
Derrick, I think even folks that are, that question the value of the economic value of tariffs in general, they kind of recognize that some of this strategically important stuff, maybe that we learned was strategically important from the pandemic when the trade, the cycles were all disrupted and the trade routes were disrupted. That makes some sense. Is it clean energy? Did they have a focus on bringing this stuff onshore as much as possible?
There's been a lot of discussion of that across multiple administrations. The Biden administration was in favor of that. The Trump administration is in favor of onshoring manufacturing generally and of energy security, independence, even dominance, as they like to say, generally. But that's a hard thing to achieve with tariffs alone. Ultimately, a lot of the solar factories, battery factories, EV factories that are coming up in the U.S. are dependent on imports, whether those are imports of upstream components or of the manufacturing equipment needed to make the final products, solar panels and batteries themselves. And right now, we're seeing costs go up on those across the board. Unless you have more reliable revenue streams, like tax credits, for example, it's kind of hard to imagine new decisions to build that stuff out. Even things that are already being built are facing uncertainty, not only from the Trump tariffs, from other investigations into tariffs being run at the Department of Commerce and U.S. Trade Representative, but also on the fate of those tax credits, which is going to help guarantee their revenues in the long term.
Yeah, it was a great point, which leads us to the IRA, the Inflation Reduction Act, which, clearly President Trump hates that thing, but there is a lot of value in it through the tax credits and subsidies for companies that supposedly he is a fan of, like the oil industry, for example. When do you think we're going to know the fate of the IRA and those tax credits?
That's a great question, and I've been wondering it myself. Obviously, we're seeing a lot of wrangling between the House and Senate about the top lines on their big budget bill they're going to try and pass by the end of the year. Obviously, the end of the year is when individual tax rates go up, and so that's one of the big forcing functions. You also are seeing the X date, the debt ceiling, occurring somewhere between July and maybe September. And that's going to be a point where there's going to be a lot of pressure to pass a big budget package, raise the debt ceiling, and probably also get some of this tax material done. But we've seen a lot of deadlines blown already for when we were allegedly going to get top-line packages, which are a precondition to figure out what's going to happen to what tax credit. And we don't even know that yet. At this point, we don't even know if they're going to use this particular budget gimmick called current policy, which would really reduce the pressures to cut more. And as they're trying to use that, we're seeing a lot of blowback from fiscal conservatives in both the Senate, but especially in the House. And so we'll see.
Thank you so much to Derrick Flakoll, BNEF lead U.S. policy analyst. Bloomberg Intelligence recently hosted its 4th Generative Artificial Intelligence Conference, and there were some great lineups in terms of how you apply and make AI.
For more, Alix and I were joined by Jim Stratton, Workday's Chief Technology Officer. The AI platform Workday trades under the NASDAQ ticker WDAY.
We first asked Jim where Workday sits in the AI space.
Workday builds and deploys and serves enterprise finance and HR for major corporations, for state higher ed, for large institutions. And AI really is built directly into the products that we build. So if you think about the different types of workflows around running a business, around running a major business, all of that is ripe to be infused with AI for automation, for ease of use, and that's really what we're building and deploying now.
So to what extent, I guess a lot of us lay people are trying to get a sense of, is this just the next step in the evolution of tech, or is AI a leap, a step function? How do you think about the technology of AI, the compute that it, and the applications coming from that?
It is the next step, really the next evolution in technology. But I think the leverage that we can get out of AI, it really is a leap in terms of it's an exponential growth in terms of productivity, in terms of enhancing humans and the capabilities of what we have in the workplace. it really is an exponential leap for us in the technology space.
So give me a use case. So some of your clients like GE or Visa, right? I come to you and say, hey, Jim, what are you going to do for me? And how does it help me and make me more productive or something along those lines? What does that use case look like?
So if you think about, I'll give you a couple examples across HR and finance.
Please.
So think about the recruiting space. So talent acquisition, you have in many cases thousands of jobs, hundreds of thousands of jobs that are open across even just the US here. Within a particular company, you may be sourcing for 10, 50, 100 jobs, or literally thousands of jobs across a large enterprise. And you're getting, in some cases, hundreds of thousands, millions of resumes into those jobs, literally that many resumes. It's really hard to go through and source that. AI is a terrific space, and actually we have a recruiting agent out in the market now that helps significantly with that sourcing problem in terms of weeding through who are the best candidates, what are the best skills, depths of skills. Even some of those skills are hidden. AI is actually really good at mapping that into a job requisition and saying, you know what, these are probably your top 10 candidates, and then handing that off to a recruiter to then go do the human engagement, interacting with those candidates and finding the best fit. That's already out in the market, and we're seeing incredible improvements in terms of talent acquisition efficiency, what the recruiters are able to source, how quickly they can fill roles. On the finance side, I'll give you a quick example there as well. Our finance teams and every finance team at every major company out there spend tons of time poring over contracts to understand the details in those contracts and how that maps directly into their books, into their financials. AI is fantastic at not only extracting information off of contracts, but summarizing that and actually directly mapping that back into the GL of a company. That's also out in the market for us, and we're seeing great gains in that in terms of efficiency of what the legal and finance teams can do.
So with what level of confidence can you say that all this money that's being spent on AI is generating a positive return, or will generate a positive return in a reasonable time?
Actually, that's a great question. There's a huge amount of money that's being spent just on the pure advancement of frontier models of really research AI. And we are seeing incredible gains in terms of those moving to what we call reasoning models. So the ability to actually think through a problem in multiple steps and then actually go action against that. I think that's going to have really broad application across lots of things, not just enterprise software, but just how we interact with everything in the world. But directly within the enterprise world, we're now very much focused, and I spend a lot of my time talking with CIOs out in the community, and they're thinking about this exactly the same way. It is, how do we've already spent a bunch of money trying things out, playing around. Now we need to show direct ROI back in those investments, and that's the part where we are now, is the products that are being built, the problems that people like Workday, companies like Workday are focused on solving are direct ROI. How do we get efficiency back into the business? How do we reduce risk in the business? Those are the primary areas where we're going now.
Our thanks to Jim Stratton, Workday's Chief Technology Officer.
Coming up on the program, we're going to break down how drug makers are being impacted by policy in Washington, D.C.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We move next to the drug and pharmaceutical space.
The Trump administration recently rejected a plan to pay for obesity drugs for Medicare patients.
And drug makers may now need to rely on Congress to expand obesity drug coverage, with a potential scaled-down expansion possibly emerging in a future Republican bill.
For more on this and the latest news in the obesity drug space, we were joined by Sam Fazeli, Bloomberg Intelligence, Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We first asked Sam how President Trump rejecting obesity coverage impacts that market.
Of course, what happened is that this has been something that was put together in the Biden era in terms of trying to get Medicare coverage for these obesity drugs. Remember, Medicare are folks that are over 65 years old and more likely to be overweight, not necessarily, right? But more likely to be overweight and more likely to have issues to do with overweight. So it's a very important group of individuals to have these products available for. But I think there is a general sense, and I think we had expected this, so this is not an unexpected outcome, that the Secretary of the HHS, Human Health Services in the US, is not necessarily a fan of obesity drugs. However, there's a little aspect here that's important. These drugs are also covered by Medicare for those who suffer from sleep apnea and cardiovascular morbidities. Those indications and that usage has not been withdrawn. It's just the use for obesity that's been withdrawn, or at least is not being proposed anymore.
So, what I mean, can that be? That doesn't make any sense to me. In that, like, the whole point of these drugs is to help obesity. How are they going to keep that distinction?
Yeah, but Alix, not that I'd like to necessarily agree with the kind of decisions that are being made or disagree with them. If you think about it, if everybody who has a comorbidity, for example, cardiovascular disease, kidney disease, sleep apnea, and the only people who are not going to be able to get it are people who are just overweight, nothing else. That's a little bit easier to swallow than if they said, okay, we're just going to ban it, because those elements of protecting patients, that is important for health. Now, if these other obese people ended up, the ones who are now not being included, just obese and no comorbidities, having one of these issues, they would be included. So I think the issue here is some folks believe that all of these things should be solved by eating better. Of course, we all want to do that and not eating too much, et cetera, et cetera. However, society shows us that that's clearly not possible for a lot of people, and they end up in a situation where they gain weight and they put in more energy than they spend. That's where the problems arise. But so I don't think it's really as bad as it sounds when you first look at it.
Novo Nordisk is down. Is that just the obesity play unwinding for this name?
Well, you would think to yourself, well, why would it for this name and not for Eli Lilly?
Right.
We've always believed that Lilly obviously has a lot more going on, but we all know that Lilly is particularly driven with the obesity aspect. We also know that the obesity drug from Lilly, Zepbound, has outperformed Novo Nordisk Wegovy. We also know that Novo Nordisk is based in Denmark, and there's this fight going on between, or at least heated conversations going on between the U.S. administration and the Danish authorities. So I think you can pile all these things up on top of each other and worry about Novo more than you would about Lilly.
All right, fair enough. What about the rest of the sector? What are some themes that are on your mind?
Yeah, so vaccines continue to be a theme on our mind, which of course there's always words that that are spoken or statements that are written that seem to suggest that vaccines are a good thing. MMR is a good way of stopping measles, but they don't say you got to go out there and get it. That's what's missing. On the other hand, we also have an issue with regards to what I feel like is a I don't want to call it an attack, but an undermining of research in areas which are infectious diseases, which I just do not understand. Mm-hmm. Why a tuberculosis expert would lose their funding. These are not diseases that no virus has been annihilated, maybe smallpox. But I think if you think about it, measles, we didn't have any deaths, we have them now. As soon as you let your guard down a little bit, it all explodes. So I am worried about that because I love the United States. I love coming there. And that is something that clearly is a worrisome aspect for me.
Is it shared to any extent in Europe, Sam?
Oh, I mean, of course. Vaccine hesitancy isn't a specific US issue. Mm-hmm. The thing is that what you don't want is that hesitancy to be fed from top healthcare officials. Over here, we have that hesitancy. Don't forget, the person who put together the MMR study and the discredited MMR study and autism link is a UK individual. Mm-hmm. But that's been discredited. But the UK government and health services have continued to push that this is the best way to get folks protected. But so it's not, hesitancy is not just a US issue. It's everywhere. What you need is health officials to be pushing it.
Our thanks to Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries and Senior Pharmaceuticals Analyst.
We move next to the banking sector.
Wells Fargo recently became the first bank to abandon its climate goals as political sentiment in Washington, D.C. shifts.
The firm's abandonment of net zero financed emission goals puts around 0.5% of its market value held by ESG and climate funds at risk should investors choose to divest.
And for more, we were joined by Shaheen Contractor, Bloomberg Intelligence Senior ESG Strategist. We first asked Shaheen for more context on what Wells Fargo did.
So Wells Fargo abandoned its climate financing goal in particular. So that's the emissions from its loan book. Typically, it's a much bigger emissions chunk than its sort of operations. So just to give you a sense of scale, it's about, I would say, 95% of its total emissions. So that's what Wells Fargo did. Other banks like HSBC have delayed their operational emissions. Again, that's about 5%. So that's a much smaller piece.
So how do we distinguish between, headlines where it's like forgetting climate goals and just sort of changing climate goals for some of these big banks?
Well, you have to dig in. I think the difference is, again, that operation versus financed. Mm-hmm. It's not as, how do I say this, as binary as like diversity, where they can dilute the language a little bit. Carbon goals are either there or not there.
Okay, so it is actually binary.
Yeah.
Are they walking away? Are they saying we're not going to restrict our lending to companies that have to fossil fuel companies? We're not going to do that anymore.
Correct.
Right?
So that's in a way what they're saying, because what a finance goal would mean is we're going to reduce the emissions from our loan book from X to Z, and that would probably come with reducing to these sectors.
Okay. Now, what's JP Morgan, what's Citi, what's Bank of America said?
Nothing yet so far.
Okay.
So they have exited the Net Zero Alliance.
Okay.
That being said, they've still been on track with their goals. They've still reduced emissions. That is in line with their targets. What's also interesting is Wells Fargo has also done that, but it's still abandoned its goals. So what's to come, we'll see.
Well, it's interesting talking about abandoning goals. Like Airbus was just saying that they still want to get to that net zero by 2050, but they're constrained by like infrastructure and technology, et cetera. How much of that is wrapped into the conversation? How much of that is a load of nothing?
So Wells Fargo in its statement actually said that they attribute this to changing customer behavior, to politics, to a number of things. However, given that they're quite on track to achieving this goal, which is also an analysis we've done, we've attributed it to politics.
So the politics in the U.S. are different from the politics, obviously, in Europe, for example.
Correct.
So are we seeing any of the big European companies or sectors of companies walk back some of their ESG goals?
So in a much smaller way, yes. So again, HSBC and UBS have delayed their operational emissions goal. Again, that's I would call that almost insignificant for a bank. So they have. The bigger piece is the financed emission goals, which we'll see.
So if I'm a shareholder, if I'm an ESG fund and I own Wells Fargo, do I just sell my position here?
So it could be at risk, yes. I mean, climate is quite high up in ESG funds agenda, and we've done the analysis. So for Wells Fargo, about 0.5% of its market value is held in these ESG and climate funds. Honestly, that's quite small. Right? So the risk lies in other more exposed peers following.
So just give me a sense, once again, I know we've gone over this number a million times. How much money is in ESG funds, roughly?
So if we look at ETFs, which is the analysis I've done, it's about, I would say, close to 600 billion. Now, let me go back. So I did this analysis 2 years back. At that point, all ESG labeled funds was about 2.3 trillion. So that's to give you a sense of scale.
So
now
it's really declined in funds flowing out of ESG funds.
No, sorry. So I go back to the 2.3 trillion number, which is all ESG funds. The ETFs are a much smaller share. So I would say that we've not done that analysis more recently, but it is 2.3 trillion is quite a large, substantial share.
When you talk about the amount of assets that are in broader funds, not just ETFs, but just broader funds, what are the numbers that we're talking about here?
So that would be the 2.3 trillion that I mentioned. So this is all funds with words like ESG, climate, etc. I would say a lot of those funds are changing names. So
we don't know if they're going to be labeled that later on down the road.
Correct.
Okay, what's your biggest call for this industry for this year? Like, what do you think the biggest change is going to be?
I think, given the recent headlines, I think a lot of it is divestment risk, which I don't think people realize. I don't think people realize the ESG investor base that is in a company. So for companies like State Street, for example, they've axed their diversity policies, for example, and 3%, well, up to 3% of their investor base is actually in ESG funds. So I would say that's quite an exposure.
Our thanks to Shaheen Contractor, Bloomberg Intelligence Senior ESG Strategist.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.